Now, these are some of the companies. If you look at, for example, some of the companies, they issued shares, and some companies restructured debt. And I think a lot of them got into problems. That's not germane to the point. But there was one trend which basically was across the board, and a large number of companies jumped to the bandwagon. Look at this number, $6.52 trillion. This was the amount of de-equitization which took place in USA. Okay. So buybacks, partly it happened in India also. You do a buyback. What happens? The equity goes down and your EPS goes up. Okay. You replace your capital structure as more of a debt, less of equity. Okay. So on one hand, your lesser, more debt, which is tax deductible expense. So you have your earning being higher and your equity number of shares go down. And then you have a higher EPS. The market is enthused. The market value of the company goes up. Okay. So this was a great, strategy by a lot of companies, used basically to shore up their so-called value of the businesses. Yeah. So this is a look at the size of average buyback. This is what I'm saying. 2021, when the prices of share went down sizably, so you could buy for a same amount a sizable equity back. Look at the top companies: Apple, Microsoft, Oracle, Alphabet, JP Morgan Chase. Okay, these are $100 billion above plus kind of buybacks. Some number we are talking about. I think probably we don't really have an appreciation of a $100 billion plus kind of a number. Okay. So these are the companies which de-equitized their balance sheets. Now the tide has turned. This is what you call exciting environment. Environment for corporate finance. Why is it challenging? Is that it doesn't remain the same. Very, very short time, you get to see a different picture. Now here, for the first time in so many years, look at the white line, which is basically US corporate bond index, and this is equity. So bond for the first time, okay, is showing that it's okay. Now equity issuance is going to come. Cost of debt has gone up, so there are a lot of equity issues are now in the pipeline. So earlier debt was the darling, now equity is the darling, right? As interest rates have gone up. So that was about the capital structure decisions, which is basically that how do you finance your your business. Now we come to the dividend decision. It basically is incumbent on how the company is positioned for future growth. Look at IT companies. Look at for example FMCG companies, which are generating huge amount of cash, and if they can't find profitable opportunities to improve their ROE or at least maintain at the same level, they normally tend to return back to the shareholders. Now, this is a very interesting aspect of human mind, human nature. It gives you power. More money with you, you get kicks like a CEO. Okay. I have $100 billion in my bank account. Now I'm waiting for the right kind of opportunities. Now somebody else might have opportunity. Your stakeholders may have decided something. Why don't you return the money? Now that decision is critically on that. What is my growth options? But I think we have very interesting ones. Listed companies, whether, of course, PSU companies are under pressure from the government to say, even if they need money, they probably will be forced to give more dividend, okay, because government needs it. Now, in private sector, listed or unlisted space, I've seen the consideration other than the monetary requirements. Now, as a market participants, I have seen that sometimes dividend considerations are even governed by what I call insider market people. I will not give you the name of the company. In derivatives, we used to do something called a dividend arbitrage. I'm giving a practical aspect of it. Okay. Nothing, no theory about it. If dividend is 10% of the strike price, the strike price of the option will get adjusted. Okay. If dividend is less than 10%, the strike price will not get adjusted. Okay. Now in arbitrage, the company in the evening declared a dividend which was anticipated to be higher than 10%, but they did at 9.90%. So the people, those who understood the game, they made large money. But I'm saying that not always the corporate decisions are influenced by that what is needed by for the growth of the company. However, that's one of the most prominent aspects of the business. Or the controller's interest. The promoter wants more money, pay a higher dividend. Now, irrespective of whether even if the company has good projects at hand, but promoters want money, you're making a lot of money, give it back. Okay. But they say there's something else coming up. Don't worry, we'll see that. You can raise debt for the same aspect. Okay. Now, this is very interesting. Since managers are in the driver's seat, they decide where they take the car to. Okay. To the destination you want, or the destination they want. A comfortable, motels on the way while on a highway. Okay. Even if your best interests are served by, you must reach in time to your destination. Okay. So it's a satisfying behavior. So as long as you're happy with unless now that I use that, what is the role of board of directors? What is the role of independent directors? Institutional investors. The corporate finance theory, I think I'm sure faculty probably would agree or disagree with me. I have no idea because I've not been part of academics. Institutional investors, as far as the company says, if you have a problem with me, sell my share and go away. I don't. Now, they can't really force the management to behave the way they want them to behave. Change the way. I want to stay in the company, but you must mend your ways. No. My sense is that large institutional investors, locally or globally, probably are more comfortable with within their own space, saying, I'm not here to change the way companies are run. I'm here to make my money and make investments. But I think they have an important role to play, which at times, and I think proxy advisory firms, among the new set of people, those who have come into the marketplace, is proxy advisory firms. Now, which is very important, they're playing an important part in the sense that when resolutions are put to vote, whether you should vote for a particular resolution or you should vote against that resolution. And now mutual funds are compulsorily required to vote on the resolution in the companies they are invested in. And I think that's a very positive step. And I see, being part of the board now and earlier also, that they are forced to make a call whether to support these decisions or not. Like, I would say that this is one area wherein the regulators, for example, are coming to terms with these difficulties, that you must have a skin in the game. Okay. So, that as managers, are you also a stakeholder? Or you are hands off? So here, for example, in mutual fund industry, every key person, they've defined the areas, they need to contribute a certain percentage of their salary to the schemes. Okay. So that means that you will be taking care of the interests of the stakeholders. Now, I've just taken a few case studies in saying corporate finance, because once I'm going to link it with the risk. Wakarangi is one company, 70,000 crore at the peak, 2017. Okay. So I think Aadhaar e-Kendras, you must have seen that, 2,400 crore rupees. It's a surprising thing that you look at the balance sheet from 22 to 23, half of their, not half, about 80-90% of their reserve surpluses got wiped out. Look at Yes Bank, DHFL, Suzlon, R Power, a whole lot of infra companies, 2007-8 which came, they've lost their market cap to the extent of about 80-90%. Okay. So these are, what did they do in terms of their financing decisions or in terms of the corporate finance, that they decimated the wealth rather than creating the wealth for the companies or the businesses they are part of. And look at the other side. Hero Motors, Infosys, Bajaj, D-Mart, Havells. I've just taken a few cases. Now, what was right? 4 crore of initial investment in 1987-88 when they got CD100, the technology from Japan, from Honda. 4 crore turned into 60,000 crores today. Okay. Now, they're making, how much to borrow, where to deploy the cash, how much dividend to give. All those decisions probably when you're looking at from a business perspective, because when the promoter is in saddle, look at each one of them. D-Mart, Mr. Damani, Bajaj, Infosys, the promoter family, promoter group, which is passionate about building a business, and they are forcing the decisions in a way which are in the best interest of business. You look at how the value creation has taken place. Okay. So that's one positive part of corporate finance. Okay. The decisions are in alignment with the business. Just 2 cases. There are you can multiply, because if it was a case of corporate governance, I would have held a complete class on who have done what. Now look at globally, for example, Moderna and Pfizer. Pfizer was small, but Moderna, they announced their vaccine. Here in India also were the cases, but they sold. And 10b5-1 is basically a plan which basically takes them away from the purview of insider trading. Okay, and they sold $408 billion worth of stock when the stock price went up. Was it in the interest of the minority shareholders? Probably their actions were not.